Good afternoon, everybody. This is Shami, one more episode, Legacy and Impact. If you are looking to start your career into commercial real estate investing, starting your own business, or you want to do something on side and want to expand your side venture into something bigger, you definitely want to listen to this podcast. Today I've got Tom Burrs is an MD out of Austin. He's a physician who decided to dive into commercial real estate investing and really practice on his own terms. Tom, why don't you introduce yourself, give us all your background, what you want to share, and really why our audience should listen to you and me in this Wednesday afternoon.
They should probably listen to me because I've made every mistake possible, so I can tell them what not to do. But I grew up here in Austin, Texas, really played a lot of sports, and that ties into the fact that, I wasn't going to get paid to play sports. I wasn't that good, but I was pretty good, but never good enough to do that. And so I was good in school and decided to be an orthopedic surgeon and specialize in sports. And so that's what I did. Went to college, went to med school, did the sport, training to be a sports medicine orthopedic guy.
Yeah.
And, that's what I did. I really enjoyed my practice. The reason I enjoyed my practice is because all the stuff we're going to talk about today. It was in my residency that the light bulb went on for me. So
Awesome. Awesome. My wife is the GI. I was telling you that. And
yeah,
one thing she told me that it's extremely hard to get into orthopedic as a specialty. Is that still the case? Or it was the case when you were? Yeah.
it is hard. In fact, my son, bless his heart, he went from firefighting to now he's in medical school, believe it or not, and wants to be an orthopedic surgeon. Yeah, it's very hard to get into orthopedics.
Plus minus?
Yeah, if you had college, it was 14 years.
Yeah. Awesome. How long did you practice and when did you stop practicing? What was those reasons and what did you do start after that?
Right on. I practiced exactly. I practiced 30 years straight through. Now, probably as you and I talked about a little bit before, probably for the last 10 years I've been practicing part-time. So I started a long time ago, 1991, practiced, and did what we're going to talk about today, and that kind of eased things up for me. But yeah, I had a nice schedule. I enjoyed what I did because I was able to eliminate the annoying things about medicine.
Yes, absolutely. Practice on your own terms, right?
Absolutely. Yes, sir.
Tom, tell us what made you first tell us what you're doing in real estate and
Yeah.
any
So
other ventures. Yeah.
what I'm right now, I'm, struggling to keep apartment complexes leased. There's always two sides to the coin, right? And it looks good on one end, but so yeah, we ended up the last 15 years doing mostly development, and so those projects that we developed or started right after COVID or in 21, 22, they kept us busy, to put it nicely. So that's what I'm doing. We're managing assets, trying to get our investors as much value as possible. I own some stuff on my own, trying to keep that afloat, and mostly managing the assets I have, not picking up any new assets. I'll put it that way. Although I believe it's a good time to buy.
It is a good time to buy for sure.
Yep.
We recently bought something out of foreclosure for a price that I don't think it will ever come again.
I believe it.
I hope I'm right because we don't want to be correct on that.
That's
I
right.
don't want to be wrong on this one. So what you're saying is about 10 years ago, plus minus, is that when you started investing into commercial real estate or start building?
No. So, and I'm sorry, I probably skipped over what you were asking, but that's all I knew was sports and, trying to chase girls. I tell people I was successful in sports, at least. I just went through the process, right? I did college. I did the pre-med. I went to medical school, got into orthopedics. I was halfway through orthopedics when I noticed that I don't know how they do engineers, but when they train doctors, they train us on the apprenticeship model. So you're getting trained by somebody that's 10 years older than you or 20 or 30. And, they're supposed to be you in the future. And I didn't necessarily like what I saw. These guys were staying late in the hospital. They were, none of them seemed to keep a happy marriage. They were all getting divorced. They were complaining and bitching and moaning about their jobs. So that happened enough times that I decided I wanted to find something that was not correlated with medicine that might give me a little bit of income so that I'd have a bit more control. That's all it was. I landed on real estate because it moved slow enough for me. I could do it part-time. I could do it with partners or without. I was too stupid to run my own business, didn't have enough time anyway, and, wasn't sharp enough to do stock trading and whatever. Real estate moved nice and slow, and it was simple math. So I didn't have two nickels to rub together because I was a resident. And so I just learned some stuff and then finished my fellowship training and learned a lot in fellowship because I was, there were a lot of wealthy people that we saw in fellowship. So I kind of closed my mouth and listened to them and got back to Austin, paid some bills, and all I knew was to go buy things. That's all you could do back then. I couldn't get into syndications because they weren't offered to me and I didn't know where to find them or that they existed. So I
Correct.
bought some small bits of real estate, bought more, got partners, got bigger stuff, got investors. It kind of grew organically. And
Yeah.
so I started that within a few years of my practice. So in the 90s, and it took about 10 years before the real estate was probably making more money than my orthopedic surgery was.
Interesting. So you were lucky from that perspective. You had that eye to see what kind of lifestyle you need, and you saw it in your attendings at the time of the residency. And you could see attendings or your senior physicians spending really trading hours for dollars. I'm repeating this because a bunch of our friends and family, and they're in medicine, and it's hard to explain somebody who have spent so much time into it, and they obviously love doing what they do. They're awesome at it. They're really helping the first line of defense when it comes to COVID. I mean, I know my wife's schedule. She had to change the apparatus in the PPE at least 15 times a day. You obviously saw that, but what was your transition look like? So did you practice full time after your residency, and then how did that transition happen? Because that will give my audience and people who are listening some bit and pieces, like what is the structure it looks like going
Yeah.
from point A to point B.
You bet. You bet. So I liked what I did. I chose orthopedics because I hang out with sports people. And so, early on, we all kind of like what we do, right? It
Yeah,
also wasn't quite as contentious as it is now, but it's not like it was without stress. That was back in the days when the HMOs were going to take over. So we thought we all weren't going to make any money back then either. So I would say to your audience that we still make an above average income.
yeah,
So let's make use of that. What I did with the extra, I tried to live, below my means, so to speak. We lived nicely, but I invested it. We all want everything now, right? I mean, we have the ability to get stuff almost instantaneously these days. Information and AI can give us answers. Creating passive income is not an instant thing. It takes some time. It took me 10 years. And all I wanted to do was pay a few of my bills. I wasn't trying to get, quote, financially free. I didn't know what fire was. It hadn't been, made up yet.
yeah.
Uh, I just wanted a little bit of money coming in, and that made me smile a little bit more and was a little bit less stress. There's a friend of mine that wrote the book Rich Dad Poor Dad, right? Robert Kiyosaki's a good friend of
Yeah.
mine. He always says everybody should be an investor, and I wholeheartedly agree with that. And that's kind of where I'm going with this. Doesn't mean you have to be active. You either need to be in the public markets or some sort of private markets or buying bonds or buying gold or whatever your thing is. I'm not going to say one's better than the other, but if you do that on a consistent basis, stuff grows. Compounding is real stuff. It really is kind of magic seeming as time goes by. You'll pay down debts and you'll gather things with interest. So I would say try to make things automatic. Try to take some of whatever money you make, try to live on less of it and take that extra piece and put it somewhere that's going to go to some sort of investment. Invest in your education, which is what they're doing when they're listening to your podcast and
Absolutely.
trying to get an
Time,
education.
yeah.
Find people that have done it. Find people like me that have made a truckload of mistakes. I'll be happy to tell you, I made a bunch of them, but I got lucky on a few. You don't have to be perfect, but don't count on it happening tomorrow. And so, stay persistent. The guy that doesn't quit wins, and compounding really works. It's all really simple stuff. Nothing's magic. There's no curtains to pull back. It's just simple math, and
Yeah.
let the compounding do the work. That's what happened to me as I started getting a little bit of income. This was just on small stuff that I owned. Psychologically, it made me feel freer. So I'll
Mhm.
tell you what I did is I stopped seeing patients on Friday afternoon.
Awesome.
I
Yeah.
was a young doctor.
Mhm.
I joke, all the doctors out there will understand. My block time at surgery was 5 p.m. on Friday afternoons.
Okay.
That's not a thing. That means I was stuck doing emergencies on Friday afternoons because I was in office all the time and everybody knew young Dr. Burns was in town, so send him all the junk. It was great. I got some
Yeah.
business, but once I started feeling a little bit, psychologically, okay, I dropped that. I felt like I had just won the lottery. I had 2.5 days free if I wasn't on call. And by the way, guess what one of the next things was that I dropped? Taking call. You know,
Awesome. Yeah.
I got tired of lowering my butt into the chair on Thanksgiving and having my beeper go off and having to leave the family.
Yeah.
So anyway, I could go on forever. Things happen, they happen slowly. You just keep adding to it. All of a sudden I was only working mornings and
Yeah.
enjoying everything I did and fired all the bad insurance companies. So that's
Tom, I wish each and every physician who is early in their career could listen to this. I honestly, I've never said this to anybody, but I'm feeling really proud to say this, that I'm feeling like I'm hearing myself from individual in Austin. People overestimate what they can achieve in 1 year versus they underestimate what they can achieve in 5 years. Right? Like you
exactly.
said, this is a slow game. It's a marathon, not a sprint. And everybody was like, they see bitcoins and crypto, and they see stock exchange and all that. Like, oh my god, this XYZ person is making so much money. It's like,
Yeah.
sure, but we don't know what they have gone through.
Right.
The other thing I want to say, you put it really beautifully, is you're not living beyond your means, meaning you were smart enough about, hey, can I can I drive two vehicles? Do I really need two vehicles? Right. Well, and
Right.
our doctors have seen one car and then one a nice car that's not producing any cash now. So I say this all the time, is like your active expenses needs to be covered by your passive income.
Wonderful. Yep.
And there's a phase, step by step phase to get there. It's not going to happen 1 year, 2 year, 3 years. I know a very good friend of mine. He's a really good surgeon. He's in between jobs. And I was chatting with him as like a regular guy, and he's got 6 months of savings to go by, right?
Yeah.
Which is still very high than an average American. But those are the things that, I wish most of these early stage physicians can hear it from you. I really hope, and we're going to push this episode more and more to most people. You mentioned one other thing. You took off Friday
Yep.
and stopped working on Friday. That's exactly what I've tell my people. It's like, if you can get to a point where you can do a 4-day work week, that'll be awesome. And then Friday, you want to go to work, sure, but you don't have to, right? And
Right.
that's almost 25% or 20% of your work time gone. And again, in case of physicians, you can stop taking calls. So it's amazing. Like, give us a little bit more background on whatever you can share. Things that you could have done differently. Things have gone that went wrong for you, and what could you have done differently to have a better version of Mr. Tom Burns?
Sure. So early on things went okay. I would lose some money. I lost in some investments. There's some doctor investments that, one MRI center went well and the next one was a flop, right? I will say one thing, that MD or DO after your name is in some ways a license to print money. It may not feel like that to some people, but we make a larger income than the majority of people out there. And so I guess my point is we should have something extra. I did have a program where I set aside money all the time, to use as investment. Things got a little bit tight and I stopped that and wish I'd have kept it up. You can always live on less. You think you'll get back to it. I did get back to it sporadically, but I wish I'd have done that just as a full rule routine all the time, never stopped it. When you get into investments, some of my worst mistakes have been reasonable due diligence, but not good enough. And the due diligence needs to be done on the person. If you're investing with somebody else, I recommend strongly for folks to do really good due diligence. Even if you've known that person for 3
Yes.
months or 12 months and they're just such a great person and they've taken you to dinner a bunch of times.
Yeah.
I suggest proper due diligence, which when I teach my folks, that includes a real background check. If you're going to give them real money, I would do a real background check, and that has a cost to it. I might have focused a little more. I tell everybody I was the poster child for unmedicated attention deficit. I bounced around to a lot of things. It gave me a really cool perspective on investments and life and things like that, but certainly probably would have done a little better if I'd have focused on certain things. I liked partnering. I partnered a couple of times. That had its good points and its bad points.
Correct.
Make sure you know who your partner is. I would submit you're going to lose money. And I've sat in front of people and said, look, you're going to lose money at some point, or don't invest in this deal. You might lose money tomorrow. And they'll say, oh, we've talked about it and we're okay losing money and we understand. We're ready to risk it. As soon as the money gets lost, they go bananas. How could we possibly lose money? It's going to happen.
Yeah.
Learn how to have some amnesia, move on to the next one. The only thing you don't want to have amnesia about is the lesson that you should learn from losing that money.
Absolutely.
And if you're not sure about something, if you're not sure about an investment, your greed is going to get you. Your emotions are going to get you. You're going to see something that you really like, and if it's something that is your first time with that asset class or your first time with that person,
Yeah.
my humble suggestion is to go in small because
Start small.
you're going to learn some lessons. So
Yeah.
why not get that lesson at a discount? Pay as little as possible because the value of the lesson is going to be the same.
Yeah.
Why not pay less for it?
What you're saying is obviously keep saving, even if you're investing or not. Start saving as much as you can and start investing from that saving and never stop putting money in that saving. Right.
I would have wished I would have done that. Yes,
Got
yes,
it. Okay. And then you also said, obviously, do your due diligence. I say this, I've said this with my investors, to our investors, to our partners. You got to do your due diligence on you know the horse, but you got to do your due diligence on your jockey, right? Horse
absolutely.
and jockey both. You can't just go alone on one thing or the other. And if you don't know, what I've seen people going really lazy on is like, oh, they want to trust that person, or they're just sold on that beautiful asset that they want to buy.
What? Yes, yes,
And that's where they go wrong. They stop. If I don't know how to read an underwriting, I should consult an underwriting expert in that field, not the financial advisor, because they're gonna tell you to invest in their stock so that they can make money over
exactly.
it.
Mm,
So you're saying proper due diligence is extremely
yeah, it really is. I mean, there have been times, when there's been some investments with somebody who's been in an affiliate group,
yeah.
where people are supposed to have, pretty good net worth or they're all good guys and everything, and people wouldn't do due diligence because that person might have been, quote, one of us, right?
Yes.
I've seen those turn really
Yes.
bad. I've actually seen those people, go behind bars. So
Yes.
I would tell everybody on this call, if it was you or if it was me bringing an investment, I'm not bringing investments out these days. I would say do a background check. I invite background checks on me or on, I would do one on you if I was investing with you. You're a nice looking guy, but I'd still do a background check on you.
Oh, absolutely. This is so true. You mentioned something really important as well on the relationship to money is extremely important, right? Your relationship to money defines who you are. Like you said, there'll be some wins and there might be some losses as well. I lost some money in in one of the deal that I invested with somebody. And the day I lost it, I called my wife like, "Hey, we're increasing our personal trainer's hour from 2 days a week to 5 days a week." And the reason I did that is because if I can lose 100 grand in investment, I should be investing more into my health. And we immediately make that decision. It was very painful because our body was sore for next 6 months, but that's what we did. So the alternative is not to retaliate on certain thing, but what you said, not to forget the lesson you learned, and then start looking at things that should need your attention or your resources. Because you lost some money, which you thought you're going to make some money, and you did not. But there are a few deals that we made 4x, and there are deals that we lost as a passive investor. With the deals that we are operating, we have not lost any dollar to date. And we've gone through this COVID cycle, and we're going through a cycle that you're going through right now with this occupancy and supply, and then COVID and all that. But what you mentioned is extremely important. Your relationship to money has to be to a point where it teaches you something rather than destroys you, right? And if
Yeah.
you can afford to invest, put the money in the shoebox. Do not invest.
Yeah, yeah. And you'll lose if you do that. I think the money's got to be active and it's just a tool. It's a tool and it's one pillar of that holds up pillar of wealth, I would say. There's money, there's your health, there's your spiritual relationships, your social relationships. So like I said, your education, your knowledge. So there's a lot of stuff that defines wealth. Money's a nice, important one for that. It does a lot of things for you. But it's, it does take time. Sometimes I've had to talk to some folks, a lot of folks in my profession to at least kind of clue them into the factor or remind them that, multifamily real estate's also not the only asset class in the world.
Yes, sir.
It's like
Yes.
one sliver of
Yes.
a jillion asset classes. And to
Yes.
keep that in mind, there's various risk stratifications, various things you can go. I used to be not a fan of the public markets, but, you know, I've walked that back. I wasn't very nice to the public markets in my book,
Mhm.
but if there's a second edition, it will be a lot more. I probably wish I would have had some money
Balance.
in the
Yeah.
markets.
Yes.
Anyway,
Yes.
a lot of things to
No,
learn.
no, absolutely. Your active expenses to be covered from your passive income. That passive income needs to come from different sources, not only single family or multifamily or storages or one source. And like you
Right
said,
on.
there has to be different asset classes, and those every different asset class have the risk profile. The important thing is that people need to spend time to learn, and that's the most important thing that most people skip doing. They have 50 grand or 100 grand to invest, and they just feel like they want to invest. Tom, you mentioned that you've been teaching people about all of these avenues and these investing structure philosophies and all of that. What does your program look like? How can somebody wants to learn more? How can they get in touch?
Yeah, it's pretty simple. I'm like the worst marketer on the planet. It's just a small group of folks. We call it a mastermind. It's, very affordable. And, it's called the Rich Life Mastermind. So I have a website, richdoctor.com, or you can email me at hello@richdoctor.com. We get together virtually and sometimes live and bring in experts to come talk about various things, and sometimes we have people show deal presentations so we can talk about them and their choice if they want to invest in them. That I have nothing to do with those deals. We
Got
just
it.
bring it.
Yeah.
We bring them for education purposes, and sometimes they like to go invest in them. So that's it. So that's my
Awesome.
full presentation of my wonderful little mastermind. Great group of folks.
Doctor.com. That's easy to learn.
Yeah.
We'll definitely make sure to add that in the description.
Thank you.
It's safe to assume that most of your audience is physicians. Are physicians?
No, I got, gee whiz, a lot of non-physicians. Now, of course, yeah, a lot of physicians do gravitate, probably well over half, maybe probably
Mhm.
more than half. But yeah, a lot of folks for some reason that are not physicians seem to tag in and like to read my newsletter. I got that too. I got a newsletter comes out every week. It's free.
Awesome.
So,
You're on LinkedIn by name Tom Burns.
yes.
Okay, cool. Now Tom, honestly, I try to keep it for 20, 25 minutes. I feel like I'm talking to an American version of myself. A physician is in Austin. We uh, we we connect on several things that I'll tell you my journey in real quick. I started into real estate because as a young engineer working for an oil gas, making some money, some decent money for a single person, and I was bitching about taxes that I was paying. And I went to different cycle and met with somebody, and my mentor told me, it's like, how much you paying? I told him what I was paying. And he told me a very big number, 4 5x time big number. And he said, you don't have a tax problem. You have an income problem because the magnitude of tax that he was paying on his income, that just changed my mindset. In all reality, I love what I did. I worked really hard to get into an oil and gas career, and I had my master's here for with a 4.0 CGPA. So I did everything what I wanted to do to get there. And that one conversation changed my mindset. And back in 2010, that's when I started buying single family homes, and I bought up to 30 plus at one time, and then I started selling it off, and then started buying multifamily. And so I've gone through those cycle of, Harvey and COVID and rates spiking and all of that. One thing I can tell is like we're humble enough to know what we don't know. And my strategy has been for last at least 7 years has been inch wide, mile deep. Right? We don't touch things that we don't know, and like just like you don't bet on every jockey, right? And we know what's going to work. So with that being said, Tom, thanks a lot for your time. I would love to chat with you a little bit more. RichDoctor.com. All right.
You betcha, Rich. I appreciate it. I enjoyed it. Enjoyed talking. It's a slow game, but it's like an exponential curve, I would tell folks. Over time it grows faster than you think. But it's closer to that 5 or 10 year mark, like you mentioned, not the 1 year mark,
Not the 1 year mark.
Be surprised if you stay at it and don't quit. So best of luck to everybody and, send me an email.
Awesome. RichDoctor.com. All right.
Take care, man.